You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back live once again on Education Wednesday. That means, lo and behold, it is time once again for Options Bootcamp, the premier options educational program. My name is Mark Longo. I will be your host, your guide, your major domo, leading you down the parade ground of options trading. Of course, you guys, if you're just listening to Bootcamp, A, we love you. B, you're missing out on a whole heck of a lot. Make sure, if you are just subscribed to this feed, you're missing out. The whole network feed is going to come at you pretty much a couple of shows a day. So it's not just Education Wednesday. It's a whole bunch more. So the Option Insider Radio Network is what you want to look for that. And, of course, if you like the network, you want to go above and beyond. You want to get additional shows in your life. We got great pro Q&As. Just did another great one yesterday talking all about the world of commodities and futures options and rates and equities, you name it. Deep dive into that. We got Options Oddities every Friday and a whole bunch more great giveaways live throughout the week for this show, everything else you want, whatever your schedule allows throughout the week, and a whole bunch more. TheOptionsInsider.com/pro, or you cool kids at Bootcamp, /secret club. Just don't tell anybody. It's a complete secret, except for all the people who are listening right now. And you know it's not a secret that he is the black-hatted one. I am joined once again, back live, I am pleased to say, by Mr. Dan Passarelli, the founder of Market Taker Mentoring, what the cool kids call to Mr. Dan, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir. I think you're so excited that you have muted yourself, sir.
Some gun. I hate when I do that.
Welcome back, sir. How was the big MTM retreat?
Oh, it was great. Oh, man. It was such a nice group of people. I refer to our student traders as the MTM family. And yeah, that is exactly what it is. Just such a great group of folks.
So give us a quick hit at the top of the show here. What were the topics du jour? What were the main discussion points going on at the retreat this week?
Oh, man, we went through, really drilled down on the Greeks and modeling trades was part of it. We went through some success stories of other traders and just kind of stories from the trenches, which Mark here was kind enough to send us a video, which people really loved. They really loved that. And
I heard they were throwing tomatoes at the screen, but hey, to each their own.
Yeah, well, we did put up, I figured that was going to happen. So we put up the plexiglass. So, it was okay.
Very smart. Very wise. We will know while you were playing that video, I was on my way to winning a flag football Super Bowl championship as a coach. So it did work out. Ooh, I did miss the retreat, but I was able to lead my son and the other kiddos to a great victory in flag football here in Chicago. So it was worthwhile, even though I did have to miss the retreat, son.
That is really cool, man. I'm glad. Congrats. That's super awesome.
Yeah, it was a fun time for all involved. Sounds like our buddy Ignacio is having a fun time on the on-demand as well. He left a 5-star review. He just said, yo, 5 stars. Hey, yo, back at you, Ignacio, I say as I hit my microphone there. There we go. Yo, back at you, Ignacio. I like that. Right to the point. Yo, 5 stars. I agree completely, as it is time to kick off the basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, print bear to learn. Yes, sir.
All right, everybody, welcome to the basic training, the portion of the show where we take some basic options concept and explore it in a little bit more depth, see how you can utilize it in your portfolio. And Dan, today's subject was inspired by one of our pro members, Donny P. You know, if you join the pro, you get to ask a lot of questions. You get to join a lot of our live sessions, of course, and our pro Q&As and everything. And also, when you have a question that you think makes a good topic for Options Bootcamp, it tends to make its way onto the show, just like this one from Tony P. He says, hi, Mark and company. Well, hello, Tony. I'm sorry. Tony P. He says, hope all is well during this turbulent time. We may have more downside to come. I've been playing a lot of defense these last few months. How about a refresher on stock repair? I'm looking at some Netflix, Nvidia, and Boeing that will probably be put to me above the market. What time frames are we looking at for stock repair? I've seen short term and I've seen a year. I'd love to hear all of your input. Thanks, Tony P. Well, that's actually a great idea for an episode there, Tony. I did a little quick look through the old archives. We haven't touched on stock repair in quite some time. So I think for a lot of our audience, especially given where we are now in the market, it's safe to say maybe more than a few of you are in the same scenario that Tony P finds himself in. Maybe you got some stock where you bought in at levels above where it is right now. So there might be a few of you who might want to consider this strategy. I'm going to go into some definitions and fun stuff in a second, but let's just start 10,000 foot. What is your overall viewpoint and what are your thoughts on stock repair as a strategy, sir?
The stock repair strategy can be a super powerful trade, can be really, really great. It's situational, and a lot of strategies are situational, but when the situation arises, oh man, it is really super fantastic. Basically, what you're looking for is a stock that, I mean, there's some good guidelines. A stock that's fallen anywhere from maybe like 20 to even up to 40% that you think is going to kind of grind its way back a little bit higher. And, I mean, we can elaborate on it more throughout the show if you'd like, or I can just kind of jump into it all here. But, it's a great strategy when a stock that you own, that you want to keep, that you don't think is going to fall much more, you think it's going to grind its way a bit higher, maybe halfway higher over the next few months.
That's a great setup. You're right. It is very situational. So let's get into what the heck is Mr. Donny P. What's he talking about? I love saying his name that way. He's clearly not Italian. I think he's Greek, but I just love saying it anyway. So stock repair, what are we talking about here? As Dan mentioned, it's usually a scenario where you come in this case, we bought our old friend XYZ, and we bought it for $100. And now we're kind of wearing it. In our example, fast forward a month or two, however long you want it to be, and XYZ has taken a bit of a beating. It is down $25 to $75 right now. So down 25%, which, as Dan kind of alluded to, that's kind of the ballpark I tend to think of stock repair falling into as well, around the 20+% range. 40 is kind of on the outside, but you can certainly do it. I've seen people attempt it and have some success with it at those levels. Somewhere, I think, in that 20 to maybe 40% ballpark range is a pretty good one. Get beyond that, and maybe it's time to really start rethinking why you bought this stock to begin with. But let's go through the example here. What are we talking about? All right. Stock repair. You bought it at 100. It's down to $75 now. What the heck? What can you do in this scenario? Well, the obvious one, you could just sell it and take your lumps. And that certainly could be an option if you think the fundamental viewpoint for this underlying and this stock have changed. No one would wave their finger at you for taking your hit. Sometimes that's the grown-up thing to do in these scenarios. Not exactly fun, but it can be the best option amongst bad options. You can also do the hopium trade, which is, now I'm all of a sudden, this stock that I thought I was going to hold for a few months, now it's a long-term hold. Now I love it. It's going to make me back all of my money and then some. So then you're kind of going outside of the rules of your trading. You're kind of throwing risk management to the side, and you're kind of just playing the hopium trade. And that's usually never a great way to go. But that is another option, again, amongst somewhat middling options. Or you can go the third option, which is the stock repair trade. Why would you want to do this? Well, this is, again, Dan said, it's very situational. It doesn't apply all the time. Stock sells off, but you might, for this situation, you might still be bullish, but maybe you're not as bullish as you were before. So you don't think maybe it's going to retrace all the way back up to where you bought it. But you think there's a little bit more upside, maybe the near-term sell-off. Maybe there was a bad announcement or something and folks are maybe overreacting in the near term. So I think you got a little bit of a bounce coming in this name, but perhaps not all the way back to where you bought it. So what can you do? Here comes the stock repair. So you long XYZ, it's trading right around $75. You already have the long stock. That is one leg of this trade. You're going to keep that long stock. Now, in addition to that long stock, you are going to buy a ratio vertical call spread, 1x2. It sounds a little bit spooky, a little bit scary. If you're not familiar with really ratios, we have done these a lot in the past on the show. Go into the archives, look at ratio spreads, ratio call spreads, ratio put spreads. Give you a good walkthrough on those in a lot more detail. You might be saying, wow, I have to buy something? I'm already down money. I have to spend more money? No, that's one of the best parts of the strategy. If you do it right, it shouldn't really cost you anything additional, but it gives you additional upside. So in our example, we're going to come in and buy, just for the sake of argument, we're only going to go out 1 month. We're going to buy the 1 month 75 call. And in our example, it's kind of rich because the stock has been moving wildly a little bit of late. So it's about $1. You might say, I don't want to pay $1 for this, but hey, you're not done yet. You're going to turn around now and sell 2 out of the money calls against it. In this case, we're going to go $10 out of the money. We're going to go to the 85 strike. And in our example, because everything is nice and even Steven, it lines up perfectly because we're going to sell 2 of those now. And they're worth 50 cents each. So now you bought 1 call for $1. You sold 2 out of the money calls for 50 cents. So your net outlay is now 0. And that's a crucial element to this trade. You don't want to really do this if you're putting on a lot of additional outlay because it doesn't make sense. You've already been beaten up. You don't want to spend more on a trade that's already cost you a bunch of money. So you want to try to structure this as close to premium neutral as possible. Maybe you have to spend a few cents here or there, but you don't want to go out and spend a lot of money on a stock repair trade. And so now in our example, what have we done? 1 month out, we have a long stock position and we have a long at the money call position, which we know makes money as the stock goes up. But we've also sold 2 of the $10 out of the money calls. Now, we've said before on this show many times, we don't want you to be net short units. You might be saying, wow, am I not net short units with that? No, you're not because you have the stock. The stock is your other leg. So you're effectively long 2 units from 75, short 2 at 85, so it balances out. So if you blow through that strike, you're covered. You're all set. You don't have to worry about being net short units. Now let's walk through a few scenarios. The stock hangs out at 75 or maybe drifts a little bit lower. Not ideal, but for our scenario, for the leg we added on, because it cost us nothing, we didn't add ourselves any additional premium, any additional risk. It really was just a kind of swing for the upside. It didn't work out, but it didn't cost you anything additional, which is nice. Or maybe now in our scenario, we rally. Let's say we rally all the way up to the 85 strike. It's an ideal scenario. It closes exactly at 85 in 1 month's time. What happens in this scenario? Well, first off, obviously you made $10 on the stock leg. That's pretty straightforward. So you lost $25 already. Now you made back $10 on the stock leg. So you're looking a little bit better there, but you're still not even really close to break even yet. And now you also have this vertical, a $10 wide vertical. Remember, a vertical can only be worth as much as the width. So in this case, it's $10 wide. You didn't pay anything for it, though, which is nice. So you can make $10 on this vertical. This vertical goes out exactly at your short strike, the 85 strike. So now this vertical you bought for nothing, also $10 in your pocket. So you went with only a $10 rally in the underlying. You went from being down $25 or 25%. So now you made $10 on the stock and you made $10 on this vertical. If expires north of 85, your stock's going to be called away. So you're effectively done with XYZ now. You can always come back and reposition if you want. But from the initial trade, you're done. And you're only out now $5 as opposed to the $20 you were in our example. So that's why we call it a stock repair. It's a great way for if you have a stock that's been beaten up, not annihilated, but it's taken a pretty good beating. And you think there might be some upside in the near future, but maybe not a ton. Certainly not all the way back to where you bought it from. How can you make yourself good or at least close to good in that type of scenario? The stock repair is one way to do it. All right, Dan, that was my kind of straightforward, everything lines up perfectly example so people can understand what we're talking about here. But Tony has some questions too about how to execute it. In particular, he wants to know time frames. He said, I've seen short term and I've seen a year. I'd love your input. I have my thoughts on this, but I would like to hear from you, Dan. When you come in and you're looking at a stock repair trade, how do you set it up? What are your strikes? How far out of the money? How far in the money? What about time to expiration? How do you usually construct a stock repair?
Yeah, there is an art and a science to this for sure. So what we want to do, and the thing that I like the most out of it, is that you typically are not really spending any more money. Now, like Mark said, like when we teach these, we always give like the textbook utopian examples where, hey, I pay $1 for these calls and sell 2 of these calls at 50 cents.
Hey, in XYZ, everything lines up. Don't blame me. So that's why I trade it.
Yeah, exactly. Right. So, you might end up paying 25 cents or even collecting 10 cents or something like that. Close enough is what we're looking for. But, you're really not putting out any more extra cash, which I love. But, to that point, we're only going to do this when we're still willing to hold the stock. And, geez, right now is a really perfect example. I come with a bunch of examples. It's a perfect time to look at stock repair strategy because I know that I own long-term stocks that took it on the chin, over the past couple of months that I'm not going to sell here. Knowing that there's still some risk to the downside, I'm willing to wait it out. So, there's probably a few examples of some stocks that people could pick that's appropriate for the stock repair strategy. Now, when I said there's an art and a science, it's really the timing of it. Like again, a perfect XYZ stock, utopian world, you find a 4-month 1x2 here, put it on, and in 4 months, it's trading exactly at that double short strike, which it's never going to be, and it never has to be. But you kind of do want to time. In a perfect world, that's what you strive for. You kind of do want to time the strategy with your expected time horizon, right? We're almost always looking for it to retrace its way halfway back if we're thinking about the strategy, because the whole idea is if it goes halfway back, you make back 100% of your money. But, if you do what I like to just call simply look to the left and say, hey, just getting context out of how this thing traded in the past, what's likely, how long is this move likely to take? 2 months, 6 months, 8 months. We always want to try and time it with that. And I used to kind of worry that, hey, if the move happens too much faster, I'm not getting all my money back. And it's like, oh boy, that sucks. But you can do adjustments to it. So it's not really the end of the world. So yeah, I guess that's the key takeaway. We're only doing this under certain situations. I'm still going to hold the stock no matter what. I don't think it's going to make it all the way back anytime soon, but I do think it'll make it halfway back over the next few months. I try and time it right. I try and make it as close to zero cost as possible. And if it goes up too early, I do an adjustment. If it goes up too late, that's okay. I can just do it again. I can let the thing expire, or take my profit on it, or, if it's up a little bit, and just put that trade on again. So it's a lot more flexible than it seems at first. And it's a great strategy. I mean, especially in this market right now.
What are your thoughts about really long-term stock repair? Like he asks here, I've seen short-term and I've seen a year put out as a time frame for stock repair. Obviously, if you want to put this trade on, it's not going to magically happen tomorrow like it does in our example where the stock retraces perfectly to your short strike within the span of a month. It's usually going to take a little bit longer unless you're trading a GameStop and the thing's whipping all over the place. So it's going to take a little bit longer than that. But I would be very reticent, Tony. And again, Dan, I'd be curious your thoughts of putting on any sort of trade like this. This goes back to our butterfly conversation when someone asked a couple of weeks ago, am I putting my flies on too tight? I think it was in SPY and also time frame. He had them on kind of long term. And we were talking about longer term flies and vertical spread is the same thing. It's 1x2, right? You need a little bit of that decay to come out. And if you're going to put it on for a year, you could get the movement in your stock and you're not really going to get that vertical to really work out perhaps the way you thought. Not certainly like in our example. So I would like to do them a little bit closer to home. I would probably do them within a few months. And then you could always, as Dan said, if it doesn't work out in that time frame, you could that's the glory of this strategy. You're not putting it on for any sort of massive outlay. So you can do it again if it doesn't. Let's say you have a 4-month time frame. So maybe you put on the vertical with 2 months and then it doesn't happen by then. Okay, no skin off your nose. You can put it on again. It still is going to cost you nothing or next to nothing. And then, of course, if you have it happen where it happens earlier, that 2-month trade is going to pay off for you. Whereas versus if you have the 4-month, you're not going to get the bang for your buck on that vertical. You have to wait a little bit. So I like the idea of having a little bit shorter term and then being able to readjust. Remember, you can also change your strikes then after 2 months. Let's say the stock has drifted up a little bit, but not a ton. Maybe you made a little bit on that at the money call, and now you're going to put it back to work, putting a different call you're buying that's now maybe a few dollars higher from where it was when you initially put the trade on. You can adjust within a few month time frame. Whereas if you have a year, you put it on a year, those are your strikes. You're locked in for that time frame, and it makes it hard to kind of be adaptive to market conditions. So Dan, what are your thoughts here on the short-term versus the long-term stock repair, sir?
Well, part of the answer to this question stems from the fact that, like, if you wanted to put on one of these trades with like a 1-week time horizon, GFL, like, good freaking luck. It's not going to happen because you're going to be buying it at the money for like $1 and those calls that you need to sell, $20 higher or whatever are going to be like, 0 bid at a nickel. Like you're not going to be able to find a decent 1x2. And, basically the further you go out into time, the more the out of the monies are worth relative to the at the monies. And so you're always kind of looking for that sweet spot time horizon too, which is balanced against your desired time horizon. So I guess the moral of the story is, I think if you go out a year, I don't think you have to go out a year to find a decent 1x2. I think the sweet spot's more between 3 and 7 months or something like that. The second thing is, well, nobody can predict stock prices ever. There are some people who say they feel it's easier to predict stock prices over the next couple of days than it is over the next year, which is sort of almost counterintuitive and ironic when you consider the level of noise in the market. But I mean, it's just a long time to wait. I mean, like if you just look at what's going on now in the market, for those of you who are listening to this live or close to it, I mean, inflation a year from now could be 10% or it could be, 1.5%. We could get into and out of a recession by a year from now. It's just a long time. To me, it doesn't make sense to put it on that long. But like I said, everything's situational. You might have a reason for feeling that way, and under the right situation, it could be a good reason.
Yeah, I think that point about the sweet spot is a good one. We've mentioned this before when we're talking about collars. And one of the reasons I'm kind of dismissive of zero cost collars is people end up having to choose strikes to make the premium lineup that maybe are not ideal, that they wouldn't have chosen at the outset. And you're going to find yourself in a somewhat similar situation with the stock repair. Your ideal time frame may line up somewhere maybe around 2 or 3 months, but you're looking at the strikes and you're looking at the premium, and you want this to line up so not to be a completely, you have to shell out a ton of cash for this thing. So that might be somewhere, maybe, who knows, 4 or 5 months or somewhere else. So that's a good point, that the sweet spot for the premium lining up. Remember, you don't want to shell out a lot to do this. You don't want to add more risk and just more cost to a position that has already cost you money. So that is going to be the big question too. I haven't had a chance to pull up what he mentioned. NVIDIA, Boeing, and Netflix. I'm sure if you go look at some of the chains there, you have to look around for a while to find that kind of sweet spot. And it may fall outside of your time frame, maybe a little earlier, maybe a little bit later. It may be strikes that you weren't initially thinking, but that's how you have to make it work in order to not spend a ton of money. That's okay to spend a little bit. You can shell out a few cents here or there for these things. You don't always have to get them for credit or even money. But if you're looking for that nice premium neutral setup, that's why it sometimes is a little bit challenging here. That goes back to, we just had this question came in initially on our Pro Q&A a couple of weeks ago when we had the once and future Dr. VIX. Mr. Russell Rhodes was on that when this question came in, and he kind of took a bit of a dismissive view of stock repair. He thought of it as kind of more of just like the magic trick that a lot of instructors use to say, hey, look how cool options are, and they're really cool, but they tend not to really work out or line up the way you want the vast majority of the time. So he was a little bit dismissive of the old stock repair. What are your thoughts, Dan, on stock repair? Is it really just a little bit of a sleight of hand to get people excited about options?
I'll tell you what, honestly, I've come full circle. When I first started working for the exchange in the Options Institute there, they showed me the stock repair, and I was looking at it all right, man, I'll teach this thing, but I'm going to caveat it because it does seem kind of like BS. And I kind of felt that way for a very long time until one day and I was even given a presentation once when somebody said, yeah, but if you don't have the timing exactly right, it doesn't work. And I agreed with them. And then I was talking about it in one of our classes, maybe about a year and a half ago. And somebody is like, oh, yeah, Dan, what do you think about using it on this stock? And it was a stock that I mentioned that I had on that was in that situation. And one of my students was like, yeah, I use this all the time. And no, the timing doesn't have to be perfect. And it doesn't have to be this utopian example. And, it's really not, like Russell says, a magic trick. It's really not. It really does work. If the stock goes down, it doesn't work, but it doesn't hurt you any more than it would have already hurt you. But if the stock goes up, it does help you. You just have to, do some ninja management to really maximize the situation. But no, I've come full circle, and I really do like it a lot now.
Done the full circle rotation on the stock repair. So yes, just bear in mind, as you said at the outset here, this is a situational type of thing. You're not going to be able to magically put it on exactly the way I laid it out in my example, where everything works out perfectly. You get a great $10 vertical for no money with only a month to go, and everything lines up perfectly. Very rarely, if ever, will it work out that way. Hopefully, your trading life, we talked about luck on the show not too long ago. Hopefully, you get the gods of trading smiling upon you where that is the case, and all these trades. Well, first off, maybe you never need a stock repair, but if you do, it lines up perfectly. But just be aware, it's probably not. You have to search around for that sweet spot a little bit, and it may be outside of your desired time frame for the stock. Let's get some questions on here. Then Dan and I have to move on to episode 2 of our live doubleheader, which all of our live folks are going to listen to right away. All you folks on demand, you have to wait a week for episode 2. We've got Nichols in our live chat, one of our pro members, saying he loves seeing pro members like Tony featured on Options Bootcamp. Very cool. Yeah. You just send in your questions, and if they make for a good topic for the show, we will definitely feature you guys here on Options Bootcamp. One of the many benefits of being a pro member. But he also has a question. He says, what about using the fig leaf as some form of stock repair strategy? interesting idea. The fig leaf listeners, if you're not familiar, that's what Brian, who on the sister Education Wednesday show of Options Playbook Radio, that's what he refers to as effectively a stock substitution type strategy. So you're going to go out probably at least 6 months, buy some sort of in the money 65, 75, maybe 85 delta call. And you're going to then, that's going to be 6 months, maybe a year out. And then you're going to turn around and sell very near term out of the money calls against it. It's not quite a covered call. That's why it's called a fig leaf. You have an in the money option and then a kind of effectively a diagonal, a very near term short dated out of the money option as well. And you're going to hope that over time, the short dated premium you're selling is going to help offset some or perhaps all of the premium that you paid for that fig leaf. The difference with the fig leaf, Nichols, is you'll see what I just said. I mean, the whole point of the stock repair is to not add on more outlay, more expense, more risk to a trade where you've already been beaten up. In the fig leaf, if you were to do it, you're going out and buying a very meaty, very expensive option. It's not that different from buying more stock. Price-wise, it's going to be cheaper. It's more capital efficient to buy a 75 delta call than it is to go out and buy more shares of the stock. But from an outlay perspective, you're not that far away, and certainly a lot more than a no-cost vertical. So the whole point of the stock repair is not to add more of a cost burden to a trade that has already been beaten up. If you're going to do the fig leaf, that means you're now super bullish on this stock. You're taking effectively too long underlying positions. That little dinky call you're selling every week or every month is not really going to change things too much. So you need to be super bullish on that. And also, you better hope so, because you're spending a lot more money on a position that has already been beaten up. Dan, what is your takeaway on using the fig leaf, so effectively a stock substitution trade, and using that as a stock repair trade instead?
I mean, it could have its place doing that for sure, but I mean, it's a different conversation than we've been having. The stock repair is a lot more pure in those objectives where you're not adding any extra cost. If it goes halfway up, you get back 100% of your money. The fig. Well, I mean, I call it a poor man's covered call myself. It's a little, I mean, you're adding more risk to it, you're not changing that trade and modifying it to be more strategic. You're just like, in some ways, kind of doubling up a little bit. Now, it's not an exactly right statement, because buying the in the money call will have less risk than buying the stock, but I think most of the time, I think it'll be generally less efficient than the true stock repair strategy. It's a different animal. I don't know if it's really designed for that, generally speaking.
No, definitely not. It seems like you're right. Stock repair is for that specific scenario we talked about. You gotten beaten up. You think it might retrace a bit, but not as far as it was when you bought it. You might be able to take advantage of that to make some of your money back. This version, the stock substitution version, is the stock has been annihilated, and now you love it. You want to double down and buy more at this lower level. That's kind of what you're talking about there, and that's where the meaty stock substitution leg comes in. So I would not view these two trades as really being identical. They are very different in a lot of ways. So a great question, though, Nichols. And if you are in the pro, you want to get in there live and access us, or maybe you want to suggest topics for the show, you know where to go. theoptionsinsider.com/pro. And Mr. Dan, where should folks go if they want to hit you up maybe about next year's retreat, sir?
Yeah, well, I mean, between now and next year's retreat, we actually we planned another mastermind, which we don't really advertise.
Are you doing another biography of me again, sir? You've already done these before. I don't want people to get bored with the same content over and over again. So.
The picture of the shirtless picture that you sent to us to pass along to our people, we decided against that last year. I think we're going to stick with it. You
need visual accompaniment to the in-depth documentary that you produced.
Right, exactly. Yeah, so we've only done this a couple of times in the past, but we're planning a mastermind, and it's kind of a little bit sort of invite only. But if you've got some experience and you want to really sort of get deeper in with the MTM family, but again, like if you're really brand new to trading, it might not be time for this. But if you've got some experience and you really want to be surrounded by some of our real elite upper echelon traders, hit me up on our website. And if it seems like it's a good fit, we can talk a little bit about it. But all you have to do is go to markettaker.com, 2 T's in a row. Market as in stock market, taker as in take what is rightfully yours. And just hit contact us and just ask for details about the mastermind if it's something that you think might be a really good fit for you.
MarketTaker2Ts.com is the place to go. We got to get on out of here, listeners. So for all of you on demand, we thank you for listening. We'll see you again next week. For all you live folks, get those questions ready because we're coming back for a doubleheader extravaganza with episode 2 being all things mail call. So we'll see you live folks next. We'll see you all you on demand folks next week, another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.